All right, let's dive right into this explainer and unpack the mixed signals surrounding CarGurus following their first quarter 2026 earnings report. If you've been watching the automotive digital space lately, you know that CarGurus is a dominant player. But their recent earnings release? Well, it's left the market scratching its head. On one hand, we're seeing fantastic top-line momentum driven by artificial intelligence. But on the other, we're looking at some glaring bottom-line complexities. So we're going to break down exactly what's happening under the hood. And this brilliantly illustrates our central mystery. Simply Wall Street data reveals a massive divergence. Why is a top automotive shopping site experiencing a 25% short-term dive despite a strong 48% long-term gain? A 25% hit over just a month is definitely enough to rattle even the most seasoned investors. But if you zoom out to a 3-year horizon, shareholders are actually sitting on a nearly 49% total return. That tells us the long-term engine is working, but there are for sure some short-term potholes we need to navigate. To solve this paradox, we're going to systematically break down the CarGurus story. We'll start with the stock paradox itself, unpack those Q1 2026 earnings, check out their AI and dealer network growth, look closely at some warning signs and impairments, and finally, debate the ultimate valuation. Section 1. The CarGurus stock paradox, surfacing the core mystery. First off, it's absolutely crucial to remember that CarGurus isn't out there actually selling cars. They make their money primarily by selling advertising, subscription tools, and lead generation to dealers. As Alpha Spread points out, they sit right in the middle of the used car buying process where trust and price transparency matter the most. Think of them as a traffic and software layer. Consumers use the platform for free, and dealers pay for visibility and software solutions to manage their inventory. Understanding that business model distinction is critical to grasping their financial leverage. Moving to Section 2, unpacking Q1 2026 earnings, a tale of two metrics. Now, this is where the plot thickens. Look at that sharp contrast between the top-line growth and the GAAP bottom line. We're seeing a really robust 15% revenue bump to $243.6 million and a strong adjusted EBITDA of $80.2 million. That's actually up 17% and beat the high end of their own guidance. But look right in the middle there. GAAP net income dropped by a concerning 23% down to $32.2 million. When Wall Street sees double-digit revenue growth paired with a double-digit drop in unadjusted net income, well, alarms go off. So, how is management countering that profit dip? They're aggressively returning capital, buying back a massive 29% of their outstanding shares since December 2022. That includes $175 million in Q1 alone. That is not a typo. Buying back nearly a third of your company in under 4 years is a huge vote of confidence from management. Mathematically, it boosts earnings per share, but it also drains cash reserves, which we'll take a closer look at in just a moment. Let's move to Section 3. AI and dealer network growth, revving up the core engine. So what's actually generating that impressive 15% revenue growth? As CEO Jason Trevisan highlights, it's heavily reliant on embedding predictive intelligence and AI-powered products directly into the dealer workflow. They aren't just selling digital billboard space anymore. They're integrating AI like ChatGPT to deliver actionable insights directly into how dealers price and market their cars. This makes CarGurus incredibly sticky as a software service. And you know what? This tech investment is clearly paying off. The dealer network expanded by 7% globally, bringing total paying dealers to over 34,500. Even more impressively, the quarterly average revenue per subscribing dealer, often called QARSD, jumped by 8% to $6,647. They aren't just adding more dealers, they're successfully upselling their existing ones onto higher-tier AI-powered packages. Let's break this down geographically. The US market is their bread and butter, growing at a steady 4%. But check out that explosive 17% growth in international dealers. That drove a massive 39% jump in international revenue year over year. On top of that, consumer engagement is surging. Daily lot visits are up 67% since Q4. It creates this powerful flywheel. More engaged consumers generate more leads, which attracts more dealers, who then pay higher subscription fees. Section 4. Warning signs and impairments. Looking under the hood. To really understand the stock's 25% pullback, we have to look past the shiny top-line numbers and investigate the red flags. The biggest culprit for that GAAP net income drop? A nearly $20 million impairment charge. Simply put, when a company realizes an asset they own, like software or equipment, isn't worth what it used to be, they have to take an impairment charge to mark down the value. While it's largely a non-cash accounting adjustment, it directly hits that GAAP profitability number. And investors, they never like to see past investments written down. Then there's the cash situation. Their cash and cash equivalents literally plummeted from $190.5 million down to just $72 million. That was largely driven by the aggressive $174.4 million spent on those share repurchases we talked about. Now, while buybacks reward existing shareholders, this sharp drop in liquidity definitely reduces their financial cushion. If macroeconomic conditions in the auto sector were to worsen, having $72 million on hand instead of nearly $200 million fundamentally changes the company's risk profile. When you add in guidance forecasting, margin compression for the full year, plus rising digital competition, you can start to see why the market got a bit spooked. Management specifically noted that 2026 is an investment year, meaning heavy spending on AI and product innovation. Also, they recently completed a full wind-down of their car offer wholesale operations. That retreat from wholesale, combined with near-term margin pressure, really forms the core bear case that's been dragging on the stock price. Which brings us to Section 5, the valuation debate, pricing the future. So what's the road ahead look like? Well, according to analysis from Simply Wallstott, there's a pretty strong narrative right now that CarGurus is actually trading at a meaningful discount. They point to a fair value of almost $36 compared to a recent close around $28. The bullish thesis here is that the market is just overreacting to the short-term impairment charges and margin compression while totally ignoring the sticky high-margin revenue generated by their AI tools and their expanding global network. Management's Q2 guidance backs up this idea of moderate, steady growth, projecting 10% to 13% top-line expansion for the full year. Look, they aren't promising the moon here, but they are projecting highly consistent double-digit growth. If they can actually hit these targets while they continue to scoop up their own shares at a discount, the mathematical upside for the stock becomes really compelling. So as we wrap up this explainer, I'm going to leave you with one final question to think about for your own research. Are you looking at a deeply undervalued AI-driven marketplace or a value trap hiding behind aggressive buybacks? The raw data points to a fundamentally sound business model, successfully pivoting to AI software, but with some near-term accounting bumps and cash burn that might require an iron stomach. Take these numbers, dive into the research yourself, and see where you land on the CarGurus paradox.